If the stock market is regularly bouncing around all-time highs, does that mean that it's a terrible time to invest? Shouldn't we instead just wait for it to go down and then buy our investments on sale? If we wait for this proverbial Black Friday sale on stocks, aren't we more poised to set ourselves up to make the most money possible? Let's talk about it. Hey, I'm Brendan, and every week you're subscribed here, you get a new video about the productive use of your time and money. First, let's clarify exactly what we're talking about whenever people say the market is at an all-time high. Oftentimes what people are referring to here is both the S&P 500 and the NASDAQ. They'll kind of use those things interchangeably and just call it the market. So what's the S&P 500? It's a combination of the 500 largest US stocks by market cap or market capitalization, and that just means the figure that the stock market uses to claim that the company's big or not. It combines all 500 of those companies and puts them into one number. And whenever you combine a bunch of companies together like that, then we typically call that an index. It's just like a recipe for your favorite food dish. It's a list of ingredients that come together to form the whole. The S&P 500 officially started in the form that we know it back in the 1950s. It's sort of a handy reference overall, and it doesn't encompass the whole stock market by any means, but it's sort of a nice way to just throw a quick reference at those top 500 companies. And oftentimes when people talk about the market being up or the market being down, what they mean is the S&P 500. The other thing people mention whenever they're talking about the market is the NASDAQ. And the NASDAQ is actually a whole market exchange in and of itself. So think of that as the place where the actual market trading happens, where the buying and selling is occurring. And nowadays that's a lot more lines of code than it is physical lines of people or desks or any kind of physical location. So whenever someone says that word NASDAQ, most of the time they probably mean the whole NASDAQ Composite Index, which is another index. It tracks basically every stock that is traded in the NASDAQ. And this is sort of like the entire supermarket instead of just the recipe card. The NASDAQ has over 3,300 companies in it, and it's also been hitting all-time highs alongside the S&P 500. As we're breaking new ground in anything as humankind, like land speed records or exploring space or the depths of the ocean or doing something kind of for the first time, it's always an adventure, and it's always a little bit scary because no one has any real precedent to compare it up against. Well, the last time we were at all-time high, it's just a different thing than it is now. And typically whenever we do these kinds of things, they're extremely risky because we're beyond our realm of expertise and we've burst out into this void of unknowns. So what does that kind of thing mean for the stock market? There are all kinds of different things that have led to the market being at all-time highs. For one thing, we're bouncing back from 2020, and that's huge. Jobs are being added, people are seeing all these different waves of new opportunities and they're taking advantage of it. There's a lot of new building and new development happening. So just all across the board, there's a lot of activity. And in kind of a meta sense, the stock market is meant to be hitting all-time highs. It shouldn't be kind of sitting around the same area because it means we're not growing. And a lot of these big companies are set up to grow. So after March of 2020 put these companies into a tailspin and everyone had to really recover for the last year, now it's not only time to get back to business, but there's all this pent-up demand, pent-up business, pent-up spending from people like me and you and everyone else, that now we're getting hit with this entire wave of growth. Now let's talk about the problem with all-time highs. Well, like I started to mention before, they're scary because it's uncharted territory. And it's like whenever Sam and Frodo are leaving the Shire and he says, whenever I take one more step, this will be the farthest from home I've ever been. Well, Sam, newsflash, buddy, you're about to go really, really far. And that's kind of what the stock market is like. And Sam's journey was really rough, and though he did go very far, it was difficult. There were a lot of ups and downs, and a lot of people will take something like a stock market high to say, this means that there's a big low coming. It means if we've gone up, we must go down. And to a degree, that's true. The market can't always be at all-time highs. We have to count on there being variations, drops, even recessions. And here's something to know. If anyone claims otherwise, they're wrong. It cannot be at all-time highs all the time, and there can't always be a recession right around the corner. There's also a lot of misunderstanding around all-time highs and how the stock market differs from other markets. So as an example, I'll tell you a little story from my personal life. I was hanging out with some friends the other day, and we were kind of casually talking about stock market investing, buying primary homes, buying rental real estate in the form of residential homes, and this whole topic kind of came up. In Arizona, where I live, it's just been a completely ridiculous red-hot real estate market, and we are for sure at all-time highs with our homes. It's like this in a few different places in the country, but Arizona is one of the hottest markets, and it's 10 plus offers on every house. Everybody's selling for way over asking price. It's the house is on the market for hours. It's just total madness. Not to say they're not worth it. Arizona's awesome. You should live here too. Welcome. Come on in. Bring some sunscreen and a lot of water. But if you've planned to buy that single family home that you've been dreaming about, it's just a little bit crazy to see these prices go and go and go. The discussion I had with my friends was talking about this and was commenting on how, to some degree, the real estate market too is cyclical. So it can't be at all-time highs for forever. There has to be some kind of turning point and a return back to something a little bit more logical. So if that's the case, maybe this isn't a good time to buy. Maybe people would be better off to wait a little while, save up some more cash, and look for a good deal. But then the conversation took a turn. It shifted, and the same exact logic was turned to the stock market. Someone started referencing stocks and said something to this effect. Well, investing in stocks is also at all-time highs, and, I don't know about that. That feels pretty risky. I felt like this was the point in the conversation where we needed to change directions. And as much as I'm trying to not be like that guy with the people in my life who just like gives you unsolicited money advice, I kind of had to step in here and be like, hold on. What I brought up was saying that when it comes to buying a home and taking this step with your personal finances, with inviting all these maintenance and renovation costs and all these other things associated with home buying, I think that the best time to buy is when your life supports the purchase. When you're settled enough in a location to stay there for a few years, when you have the income to support the kind of mortgage that you're planning on having, those kinds of things. I think that there was an assumption going on with my friends in that discussion that was thinking that the stock market was sort of this cyclical up and down chart where things are high and things are low and things are high and things are low, that it's supposed to somehow be that sort of constant wave of ups and downs, and that right now it's clearly a bad time to get into it because it's on this up. And I just don't think that that is how things work. So let's talk about what the stock market doesn't look like. It doesn't look like what I was thinking my friends were assuming it looks like, which is something like this. A graph of things going up here, down there, up here, down there, and that the implicit game in that is to identify the times when it's down and about to go up, and you buy then, and then you wait for the times when things are up and about to go down, and then we sell out, we take all of our money, and we let everyone else fall off that cliff. I have no empirical evidence to prove that a lot of people think the stock market is like this, besides the fact that in conversations like the one I had, people say things like that, and it makes me go, how do you think this really works? In contrast to that, what the stock market actually looks like is this. It's going up over time from left to right, over the long term. And of course, this is only really what the stock market looks like for you personally if you're investing in something like a really broad index fund. Not picking individual stocks, not buying and selling all the time, because individual stocks often have a tendency to look more like that first chart than this second chart. The other part of my problem with that kind of mindset is avoiding all-time highs. The implicit thing there is to say an all-time high is a red flag. It's an indicator to steer clear. Watch out. Things are about to get bad. First of all, if we're not investing at all-time highs, we're avoiding a lot of the time that the market is available for us to be investing in. Because historically, as you saw in that second chart, there's a lot of different instances when things are technically all-time highs. So if you choose to refrain from investing every time it's an all-time high, you're refraining somewhat often. The next problem is that when you're avoiding all-time highs, statistically the year after an all-time high, the market's gone up on average 11.2%. So the whole basis of that framework of thinking that right after an all-time high comes a big low is not true. One of my favorite Instagram accounts is called Personal Finance Club, and Jeremy does a really good job of illustrating this with like little emojis and different kind of graphs and things. So if you're looking for someone to follow that's a lot quicker, like bite-sized information, go check out him on Instagram. This is completely not sponsored. He has no idea who I am, but I just like the guy and I like his posts, and he's talked about all-time highs a number of times, so you can see some of those posts here. So if an all-time high isn't a time to avoid, then what should we do? Well, technically, I can't tell you what to do. I'm not qualified. I'm not a professional. I don't have that certification, but I'll tell you what I'm going to do personally, and then you can take that information and decide if I'm a crazy guy on the internet, or if you want to do something similar, or if you just want to go buy a Mustang convertible and fill it with In-N-Out French fries. Whatever you want to do, it's up to you. Despite the market being the S&P 500, the NASDAQ, most of those kinds of metrics being at all-time highs, my plan is to do something very similar to what I've always done, and that's dollar cost average into well-diversified index funds. The fact is that I am aware and a little bit afraid of another stock market correction or recession. The potential is there. People like Andre Jick and others have made videos explaining that there are a lot of things that are kind of stacking up that look like 2007 and 2008. Derivatives are way up. People are taking all this risk. They're creating these sort of houses of cards that could collapse again. There's potential. And it's a more of a when, not an if. And so I'm aware of that. Other people have been naming things bubbles left and right, like the housing market, like index funds, like most things. They're just saying that everything is a bubble. And bubbles do one thing, that's pop. They could very well be right. And I don't want to overlook overlook what happened in 2020, which was last year, because that was a massive dip. That was the fastest, most steep fall off in the stock market's history. And so that's a significant thing, but it wasn't brought on by sort of the market in and of itself or by other kind of failures. It was a global health crisis. And so that's sort of a different factor to factor in here. So I don't think that counts as a recession or a dip necessarily in the same way that others in the past have. So all that to say, I'm still expecting there to be some corrections in the fairly near future. The problem is that as smart as anybody is, we just can't predict that accurately. There's always somebody out there saying the sky is falling, a dip is coming, this is a bubble, that's a bubble, and people take enough shots that someone will be right. Like someone will call the next thing basically perfectly. They'll get this giant burst in popularity because they were right, and then they'll keep calling shots and probably not a lot of them will hit. But the problem is if you listen to these people, you'll basically never invest because there's always something coming and there's always a reason not to, and there's always a bubble. Like there's something happening all the time that would tell you not to invest. The problem with not investing and just holding all of your cash is you're going to miss out. That is the kind of FOMO that we need to be afraid of. Like I said, statistically, the year after an all-time high, on average, it's an 11.2% gain in the stock market, which is huge. It's amazing, and I don't want to miss out on that. I'm sure there are some people out there and maybe someone watching who saw what happened last year in 2020 and went, this is crazy, I'm out of here, and pulled out money. Then if you didn't get right back in, then you would have missed this giant meteoric insane rise over the last 12 or 15 months that's also been record setting. So you see how that kind of logic can easily work against you. The final factor for me is the reality that we aren't planning to retire anytime that soon. Like at the earliest 10 or 12 years, at the latest till we die or don't retire or mid 60s. And I'm totally fine with that. So all that to say, we have some time to kind of ride some waves and let things ebb and flow, go up and down. And if you're anyone who's near my age or aren't like on the cusp of retirement, then you too have a lot of time to ride things out. And I want to be clear here. That's not to say that if you are on the cusp of retirement that you can't ride things out and that means you somehow have to be out of the market. Like people retire and have 100% equities often. And outside of getting into a completely different topic to dive into the weeds of sequence of return risk, go to Big Earn's website at Early Retirement Now and read his blog posts there. There's good reason to stay in the market even if you are going to retire soon. But in any case, the real struggle here is the emotional side of this, because whenever we look at our account balances and we see them dropping $10,000 or $20,000 over the course of a week, like that's a gut punch. That is really difficult to sit there and ride that wave and say, this is okay, everything is fine, I'm not changing anything, I can watch this go down, and then the next week it goes down again, and it just feels like you're getting walloped by Mike Tyson and it's just terrible. But we have to be able to have a firm enough resolve to say, no, this is okay. This is supposed to happen. Things are fine. This is normal and I can ride this out. I'm realizing in my life that in areas where I'm less sort of comfortable, I rely more on data and structure. And so in those kind of times, whenever things are going really badly in the stock market, I have to remind myself that statistically, the people who buy and sell the most often get the worst returns. And that even falls in the realm of professionals, because on average, a really nice index fund that's like super diversified across the whole stock market does better than 95% of the professional account managers whose job it is to get a better return than the market. So whenever you're tempted to buy and sell, get yourself in or out, to try and do these little timing things here and there, just remember, you're not special. You're not smarter than the market. It's just going to do what it's going to do, and we're better off trying to hang on. Ooh, I wonder if that's a good analogy. I just thought of something. Maybe it's like when you're riding a bull. If there's any bull riders out there watching, then call my bluff on this. Perhaps it's safer to stay on the back of the bull and just ride the bull instead of jumping off and trying to run away, because then the bull can reach you easier. Is that a thing, bull riders? Is that proper logic, or is it still just as unsafe to be on the back of the bull? It'd be cool if it was, because that'd be a fun analogy to say, just hang on, stay in the market, don't jump off, because it's actually safer to stay on. But you let me know. Hey, if you've made it this far, you either didn't hate this video or you've fallen asleep. If it's the former and you haven't yet subscribed, please consider subscribing. If it's the latter, I'll refrain from putting in loud outro music so you can stay sleeping. Remember to keep your notifications turned off and prioritize the time that you have with the people around you in real life. You don't need notifications from YouTube or me. If you want to see some more behind the scenes from me, my channel, and my training for my first ultra marathon, then check me out on Instagram at Brendan Fitness and Money and follow me there. To not miss any future uploads, click on this little circle with my face in it so you can subscribe. Hey, thanks so much for watching, and I'll see you next time. Bye.